Everybody. So thank you all very much indeed for joining us today. We are very pleased with the interest we have had in this project, which really started with a multiple research study way back in the late summer at the beginning of September, and only finished actually just a few days ago. Um, and I'm going to be getting into presenting the very broad results of that in a few minutes. My name is Simon Osborne. I am the CEO of IFI Global, which is a research and media house based in the City of London. We have 3 monthly publications and we have one weekly. The full results of the research that we're going to be talking about in a few minutes will be published in the November issue of our publication, which is primarily for US-based GPs and LPs, which is called Alternative Investment Strategies. And some of the results will also be in our fund governance publication called The Net. I'm going to, as I just said, give a short presentation just to highlight what we think are the most salient points that came out of this project. And then we are going to get into a panel discussion, and we will allow some time at the end for questions should we get some. So please do use the Q&A button at the bottom of the screen if you would like to ask a question, and you're very, very much encouraged to do so. We have a lot to get through, so I shall get on with it. Let me start telling you a little bit about the sample of this, because it's a little bit unusual. Although we have been doing multiple research projects, including in the US over a very, very long period of time, many years, if not decades, this is the first time that we have done something quite like this. That is to say that we had a variety of different methodologies and a variety of different samples. ANC advisors very kindly sent the questionnaire out to their database of US-based managers. AIRaise use their AI-driven data to get responses from GPs. And we at IFI Global use a combination of personal interviews, particularly with US-based, New York-based major law firms in this business, and also going through the written process as well. In short, it's very difficult to give you an accurate information on the sample size, but I think it's fair to say that it is by far the largest study that has been done like this for a very long time. Indeed, it's probably the only study that's been done like this in a very long time, and it could even be that we haven't done one for about 4 years or something like that. Maybe there's nothing that's been done since we last did it, so we're only competing with ourselves here. The detail on the sample and how it's all broken out will be in Alternative Investment Strategies November issue, which will be out in a couple of weeks' time. But let me thank AIRaise and ANC advisors for their help in doing this. And also, I'd like to thank all of you, and I know some people here today and many others who will be joining the recorded podcast that will be available in a day or two's time on our website, for you guys giving up your time to participate in this study as well. It's very, very much appreciated. And I'd also like to thank Apex very much for their sponsorship of this event today too. So let me get on now with the main point of what I want to do, which is the research. And I'd like to start by introducing the panel. We have Lavin Chandra, who's the CEO of AIRaise. AIRaise uses AI to capital raise on behalf of GPs. It's based in both San Francisco and in London. We have Deborah Francis, who's a partner at Willkie Farr and Gallagher, which is a major New York-based law firm, as I'm sure many of you know. And we have Don Shannon, who's private credit head of sales Americas at Apex. So thank you all very much for joining us today for this. Now, I'm going to, as I say, rattle through what we think, and some of them people might think some of the other conclusions were more interesting. But from our point of view, what we thought were the most interesting thing that came out of this study, and then we're going to get into the panel. Right. We found, certainly in comparison with when we last did something like this, which I think, as I say, is about 4 years ago, that US-based GPs are accessing European investors earlier, if not much earlier in their cycle than with lower AUMs than they did do previously. And another conclusion we found is that private credit is becoming, or has been for the year of 2025, the major growth strategy. Wealth management platforms are becoming increasingly important. Of course, they've always been there, but we found much more interest and use of them by GPs than was the case when we last did this. Of course, you have to be selected to be on one of those platforms, but if you are, it's a great way into the market. Another interesting finding, not just from this study, but in the study, but other work we've been doing this year, is that pension funds, European pension funds, will allocate to specialist boutique sustainable managers, but not necessarily managers of that size in other strategies, because sustainability is very much a growth area for them, and they are looking for specialist managers in sustainability. To perhaps my slight surprise, or that reverse solicitation as a distribution way, if you want to call it a distribution strategy, which some people would say it isn't, is still, according to this research, the most popular way to get into Europe by US-based GPs, followed by private placement, NPPR, and then finally the regulated AIFs inside the EU. That's by numbers. That's why it's first reverse solicitation, then private placement, finally AIFs. But by assets, it's probably almost certainly the other way around. And most, if not virtually all, US-based GPs that we've come across will rely upon advice from their advisors on anything and everything to do with European matters. They rarely, if ever, make decisions just by themselves. Certainly when they're in the setting up stage, once the business is established over here, that might be different. Lawyers, of course, are the main advisors, but they will sometimes have other advisors as well. Key findings. This first point on the screen is based upon the wherever it was, 6 or 7 major US-based, New York-based law firms, including Debbie. I think you're one of them. We interviewed for this process a month or two ago. And we averaged out the responses we got from them. This is the best proxy we could find because those lawyers are also dealing with US-based GPs who don't come to Europe as well. And we asked them all how much of their client base have European investors. There you see it. They estimated, as an average estimation of several law firms, estimated that 65% of their clients do, and the overall average was up by 20% over the last 3 years. In terms of strategy development, as I've already mentioned, the big growth area of the year undoubtedly is private credit. As I was saying to Don earlier, I mean, I've been learning a lot about private credit as the year progressed. It's not a single strategy, obviously. It's more like an umbrella term. It's a bit like saying hedge funds, because hedge funds, you can have global macro, long-short equity, etc., etc. Private credit covers a multitude of sins: direct lending, distressed debt, asset-backed finance, mid-market direct lending, early stage PC, etc., etc., investment grade PC. All of those things were mentioned by various people in this study at different times in different ways. Secondly, way behind, and albeit from a very low base, the sustainable sectors. Third, a biotech, and fourth, healthcare. Those are the, of course, there's plenty of other things happening in real estate and private equity and all the usual well-known tried and trodden paths, but those are the areas that we found when we asked the question, what's growing, that it has been on the up. In terms of investor categories that US-based GPs will go for, this I remember from previous research we've done it's still number one, family offices. Perhaps the big difference there is that in Europe, and indeed undoubtedly probably everywhere else too, there's so many more multi-family offices in comparison with where we were 5 or 4 years ago. And that is a very common way in for the kind of GPs that we were talking to, that we surveyed for this study. That's very obviously a popular area. I put brackets around the private for private banks because some people just said banks, some people said private banks. I decided to lump them all together, and I think mostly when people said banks, they meant private banks anyway. And fund of funds, that is often in the private bank area too. So in a way, that's almost one area. I've already mentioned wealth management platforms as a big growth area. I think that's come along a lot in the last few years. And if you're in a category which the Bank of America or JP Morgan or whoever, Morgan Stanley, whoever it is, if they want your fund on their platform, it's obviously a great way into the market. Insurance is something that at least we sometimes forget about. We don't probably spend enough time thinking about. If you want Germany, that's very important in the insurance market. And to a certain extent, Holland and Belgium, particularly the Netherlands, also as well. That is a very big way in. And then, of course, there's the pension funds. Other key findings. This is countries, again, in order of number of mentions. The UK was top, Switzerland second because of its very large wealth management sector. By the way, an important point, and by the way, I think everyone we spoke to, and it's not the case that anyone in America thinks Europe is one homogenous market. They don't. But just to emphasize that point, both the UK and Switzerland, as many of you will know in the US following this, are not in the European Union. So they have a whole different way of doing things. The other countries listed here, with the exception of Norway, which is obviously part of the Nordic region, that's out of the EU as well. The rest of them are in the EU. But perhaps the two most important markets for US-based GPs are not in the EU. Nobody we came across, I think it's anyone comes across, goes pan-European in this part of the market, in the private market space. Everyone accesses specific areas, whatever that may be. So in wealth management, I've already mentioned the UK and Switzerland. This is in terms of mentions. In the institutional markets, the Netherlands, a very sophisticated institutional market. The Nordic region, I mean, we've done events with AP7 and AP3 in Stockholm, and the ABP in the Netherlands, PGGM, etc. These were the first pension funds in the world, in some cases, all those years ago, to get into hedge funds when no one thought that was a private wealth area for them. So they are very sophisticated investors in these Northern European countries on the institutional side. And there you have Germany and UK. They also got a fair number of mentions. I think I've mentioned reverse solicitation coming first in terms of sheer numbers of mentions, not by size of assets, but that is still a surprise, perhaps. Particularly, there was a lot of talk a couple of years ago when the EU brought in its cross-border distribution directive that would be the death of reverse solicitation. That has not been the case at all. It's still going strong, and probably will remain so for some time to come yet. All medium and small size GPs that were covered by this research are interested in working with third-party distributors. Maybe the large ones aren't, because they've got their ways, their staff and the ways of doing it, but everyone below that appears to be in that category. Domiciliation, a very contentious subject for some. In a way, you can sort of make it much less contentious by simply making this very simple and basic point, which is it really does appear to be the case that it is determined by the investors. People don't sit in Boston, New York, Chicago, San Francisco and go, oh, I quite like the idea of being in Dublin or Luxembourg or Jersey or Guernsey. They really will go with what their investors that they are targeting want. That's how they determine where they end up. Luxembourg is preferred still to this day for pretty much all or most illiquid alternatives, and Ireland for the more liquid ones. Ireland is stronger in maybe areas outside private markets, such as ETFs and some other areas of the market, but on certainly in the illiquid alts, it's still very much the case that, particularly if you want continental Europe, and especially if you want somewhere like Germany, that you end up in Luxembourg. If managers can get away with it, this is US-based managers, they will go, they will use their Cayman structures, and pretty much all of them will have Cayman structures, but they are well aware of the fact that that is probably going to be difficult to do, depending on if they're going outside the private placement route into Europe and taking it more seriously than doing private placement. They probably realized Cayman is not, in the way that it once was, so much an option. If that is the case, then a lot of them will look at the Channel Islands, and it's become a tried and trusted route where they go through private placement to access even very large institutional investors in Northern Europe. Luckily, private placement, it very much varies market to market. It doesn't work well so much in Southern Europe, but it does work well in Northern Europe, and those generally are the institutional type markets that those managers are looking to distribute in anyway. So that tends to work well. Regarding, we asked them about partners selection, and the GPs coming into the EU pretty much all will use these. Some people use the term ManCo, some people use the term AIFMs, and it's very common for them, if they're coming into EU, to have a US master and then a European feeder, such as a Luxembourg RAIF or an Irish ICAV or an Irish QAIF, if that's the right way of pronouncing it. Those are all very common, tried and trusted routes. Why do they use ManCos? Regulatory help is the first reason. Investor comfort is another one. They do quite like having a good name that's well known in the market. If they're going to use one, they may as well have one that their investors are going to recognize, that can help. Distribution does come into it sometimes. They obviously will have their own distribution options, but they will take any help that they can get, if they can get it. Right, we spend a little bit of time also focusing on private credit in this research. I'm going to very quickly say this, I'm very conscious of the time. The majority of GPs in private credit that we came across are using or are planning to launch evergreen structures. That is very, very popular. It's been one of the crazes of the year, probably will be next year. The big drawback to evergreen structures are operate on the operational side of the business. And everyone says you do need experienced back office support, good systems in order to manage the subscriptions, redemptions, liquidity, etc. And liquidity in an evergreen structure is a key issue. We will touch upon that probably in a few minutes' time. Loan servicing is the key to middle office issues, followed by cash management. And there were several GPs we came across who said that the market is moving, or should move, and they wished it would move more quickly in the direction of integrated providers of back office services, which reduces errors and improves NAV times. To conclude, there is no standard way US-based GPs accessing Europe. There's no standard way they do it. Each situation is different. I think it will always be the case. GPs are using less standard investment structures all the time, and that's often driven by LPs. I said that LPs drive domiciliation decisions. Increasingly, I think they're also driving structuring decisions, and that's new. And we absolutely did not have that the last time we did research in this area. New strategies are coming along. I think that could really make a difference in the next few years. For example, in digital tokenization, and I've already mentioned sustainability, and that will add a dimension to the market. Finally, we have a thing called Atlantic Fund Intelligence, which helps US managers and managers in different parts of the world, in addition to the States, with European market intelligence, distribution options, investment structuring, and so on. and we help them on a very confidential basis find partners for their funds in those categories mentioned there: AIFM, Manco, service providers, domiciles, independent directors. It started as a service for independent directors and has moved on. So I spoke as quickly as I possibly can. Sorry for banging on for as long as I did. Let's get back to the panel. And since Don, you're in the top left-hand corner, can I come to you first? Do you want to give a bit of background on yourself before we get into the first question? Don?
Sure. Donald Shannon, head of private credit sales here in the Americas for Apex Group. Can you hear me okay?
Yep, fine.
Okay, very good. So just a little background on Apex Group, right? We are the largest independent provider of financial services to the alternative industry. We have a suite of services that provides our clients with future-proof solutions that meets their needs across multiple jurisdictions, open or closed-end funds, evergreen strategies throughout their evolving life cycle. We've been in the space, and we have about 16 years of experience inside the private credit asset class. We're servicing currently assets under advisory about $230 billion, and for some of the largest financial institutions, making Apex a really good strategic partner in this arena. We also have about 50 plus specialists that are based in Ireland and Luxembourg. Have an industry average of 7+ years servicing private credit strategies across the fund and loan administration process. And we offer a scalable and flexible module model for all of our services, which allows our clients to either scale up or scale down on functions or remove to ensure that we can tailor their services offering to each one of those clients' requirements.
Thank you. And Debbie, can I come to you?
Yeah, sure. So I'm a partner at Wilkie Farr and Gallagher. I've been in the investment management industry for about 17 years, and my practice primarily focuses on working with managers in relation to fund formation across a variety of different strategies, including hedge funds, private equity, private credit, hybrid, really any combination of those types of different products. And essentially, really just helping them think through their, business and making sure that they understand, a variety of different regulatory issues, both in the US and really throughout the world. And Wilkie has a very large asset management practice. It's 120 attorneys across a number of offices in the US and in Europe as well.
Thank you. And Lavin?
Hi, everyone. My name is Lavin Chandra. I'm the CEO and co-founder of AI Raise. We are the leading AI-driven capital raising company globally with 67,000 LPs in our network. We have 150 data points of each and every LP. Existing data, synthesized data, we're using a lot of machine learning algorithms in order to help small and growing asset managers and also the largest asset managers in the world to raise capital from our LPs. We have at the moment a number of verticals whom we are helping to raise capital. We started with real estate, expanded to private equity, venture capital, infrastructure, and also hedge funds. And we have an office in San Francisco where we are developing the AI, and an office in London where we are helping those GPs to raise capital. And soon we are going to open up another office in Singapore.
Thank you very much. Right, well, let's get on with the questions then. First, one big broad question for all three of you, if I may. Do you anticipate that there will be any particular developments that you can see from your perspective in terms of US-based GP development, of GPs coming over here to Europe, perhaps next year and beyond? Is there anything you see, any trends that you see emerging, or any developments, good or bad, in any direction? Who would like to take that first? Maybe we should come to the New York-based lawyer, because you probably see a broader spread of GPs in terms of your practice than many. Is that a fair comment? You see a range of different strategies, a range of different ways of them doing it, Debbie?
Yes, no, that's right. So, I mean, I think, as far as the practice, it ranges from a variety of different managers, some of whom are emerging managers just starting in their business. And so thinking about a lot of, kind of the fundraising, marketing issues for the first time, and then have a number of clients as well that are, more established, some of whom are, 25, 30 years into the business, have a wide range of products ranging from open-end vehicles to funds of one for institutional investors, and then have, established a number of often, kind of private market vehicles, private equity, venture capital, private credit. And so, it is a pretty, kind of broad-based group. So, I mean, I think as far as the, trends that we're seeing, I mean, I think Simon, some of this was reflected, earlier when you were speaking. I think there is, tending to be a focus towards the European markets earlier, from, the investors, particularly, people that are, a few years into the business. There is still, for emerging managers, I think there still is kind of that 3-year track record often that people are looking for in relation to the fund space. But I think there has been, some increased interest from people in Europe, particularly if, there are some differentiated strategies. I think, strategy wise, we've seen the largest growth in private credit, but, I think just given the current markets, there has been, some more significant interest in, hedge funds and those types of products. And then, I think there has been an increased focus in the US on, liquid alt products as well. So interval funds, tender offer funds, and registered products. And we have seen a few clients who have established US funds for those. Think about some offshore, feeders for European investors as well. So, and I think particularly with the private wealth platforms, there you do have a tendency towards, having, more of a European base. I think in particular, Switzerland is probably the first jurisdiction that people will often think about. But I think, Norway, and France and Germany are particular jurisdictions that people have seen, I think, more interest from originally. And those, going back to the point about jurisdiction, generally those investors are looking for a European structure, not necessarily that you have to have a whole European structure, but at least maybe looking for some kind of, feeder fund that is European based compared to Cayman.
Right. And Don, for you, being a specialist in private credit, maybe you could talk about the different types of private credit that you see. As Debbie just said, when I said, it's definitely been the flavor of the year. But what type within the umbrella term private credit, where has been the most interested? Is it in these evergreen structures? And I'd be interested to hear what else, as well as the evergreen, is developing.
Yeah, I think we've seen a significant uptick in the number of secondaries and evergreen funds that are coming to us, looking for services to provide, more transparency and better manage cash across those asset classes, to facilitate, the offerings that they're putting out there. We've seen a significant uptick in direct lending. We're seeing some more what's being deemed venture credit, and just the significant uptick of the number of private credit firms that have come into market in the last 2 years. As you and I had spoken about earlier, right? There's a lot that falls under that umbrella, and it's a matter of really kind of digging in there and having those conversations with the new entrants, or people just trying to explore this asset class to fully better understand what it is they're kind of investing in. And you're seeing, more. When the reason why you're seeing the way we appear, the way that we're interpreting what we're seeing in the direct lending, the tailored terms, the better covenants that are being presented to folks, is making the asset class more and more attractive, and the returns and the lower tendency for defaults in the asset class. There is some concerns that we're seeing with that there might be an uptick in defaults, and some of those workouts that are happening behind the scenes that aren't really made aware to the investors in the asset class. So we're closely monitoring what we're viewing as some of the challenges to come in the next 24 to 36 months in the private credit asset class.
Yeah, that wobble that took place in late October, was the first time we heard anything negative. But someone said to me, he was in the business, admittedly, so he had a particular point of view, which wouldn't surprise you if he said this, but he said, if anything, the attention has actually not been all bad on what's happened. I don't know whether you would agree with that or not.
Absolutely, and it's a way, that whole situation that wobbled and caused quite a stir in the marketplace, just puts more and more focus on due diligence by the GPs to invest in these companies and provide that credit line. And it's a double edge, right? We're seeing more requests from the LPs on transparency into these loans that these managers are doing, right? They want to fully understand what is the quality of the underlying assets. Did they do full-blown due diligence on making this investment? And just giving them reassurances that the fund managers that they're selecting are actually doing the proper, dotting of the I's and crossing of the T's to ensure that these defaults are mitigated or kept relatively low. That they're not all of a sudden, there's a catastrophe waiting to happen.
Yeah. And Larvin, I'm going to ask you about other strategies in a second, but have you got any comments on what you see that's going on from your massive databases and all your AI-driven whatever in private credit? Do you got any observations on that market?
Yeah, sure. Let me share what our data shows about where LPs are putting money and how GPs are actually evolving within private credit, and let me give you some real numbers as well. So what are LPs actually doing? First, let's speak about LP allocation trends. LPs are basically using two buckets. Bucket number one is steady income. Think high quality credit with a predictable yield. Our data shows AAA rated CMBS with target of about 5 to 6%, and senior bridge loans around 8 to 10% unlevered. That's a dependable base. Bucket number two is return boosters. This is the selective special situation sleeve. Examples include mezzanine or preferred, where targets are often 15% plus, and non-performing or complex loans where return ranges are shown at roughly 15 to 25%, depending on asset and workout path. LPs are also asking for custom accounts, SMAs, and mix and match sleeves that combine residential and commercial credit inside one platform. That lets them dial risk and liquidity. One macro point that matters, there's roughly 2 trillion of real estate debt maturing over the next 3 years. With banks retrenching, LPs are backing a strategy that can refinance, restructure, or acquire these loans. And on alignment, some offerings explicitly include preferred return, for example, around 10% plus a share of a GP promote. So the manager only wins big when investors do as well. I can also go deeper into the GPs and how they are evolving and their strategy development. So leading managers are building one-stop credit platforms at the moment. In plain English, the same team can originate, underwrite, service, and securitize. One platform we reference shows over $19 billion of real estate credit assets produced live to date across commingled funds and SMAs. Because banks have pulled back, private credit is earning about 50 to 200 basis points of excess spread versus comparable public credit. So core unlevered targets are around 7 to 10%, makes sense for senior risk, while MES often targets around 15% plus for complexity and subordination. We also see a focused niche on in hands-on small to mid balance workouts, typically $3 to $25 million assets that are too small for big institutions, but for large investors, it's the opposite, it's too big. And here, managers emphasize a deep underwriting, think deal, and multiple exit path. So restructure, discounted payoffs, foreclosure, or loan sales. And what this means for LPs and what should LPs do is, number one, balance the plate, use steady loans, 5 to 10% targets as the base, and add a measured slice of special situations, 15 to 25% for upside. Number two, pick platform GPs for managers who can source, monitor, fix, exit under one roof with scale and securitization options. And finally, number three, in alignment, prefer SMA flexibility, clear pref, and promote sharing, so incentives are straight.
Just before let's go on to, we'll have to cover some other strategies and some other issues in general, but just before we leave private credit, what do you all think? Because Debbie mentioned it's a big part of her client base. Obviously, Don's a specialist in this area. You just given me more detail than I imagined you had up your sleeve just now on it. What's going to happen next year, do you think, all three of you, in terms of private credit? And we talk about some other things as well in a second. Do you want to mention?
From my perspective, and what we're seeing on the fund administration aspects of it, we're not really seeing a slowdown. We're actually seeing an increase in the amount of people coming to our door to service their private credit funds. So I think we'll continue to see growth in the asset class as long as the returns or what they have been, and as long as the industry can keep defaults at a minimum or an acceptable level, I don't really think you're going to see that much of a slowdown in private credit over the next 12, 24, 36
months.
Well, I see it in a little bit different view, especially because we're working a lot with family offices, and the family offices are the fastest in terms of adapting to new trends. So why was credit so popular over the last, let's say, 24 months? It's simply because the interest rates have increased, and the LPs wanted to lock the high interest rates with several different credit products. Now, the central banks are reducing interest rates, or have reduced interest rates over the last few months. And if this is continuing, if this trend is continuing, then you are again on a very low interest rates. So there's not much to lock up. But at the moment, the pension funds and the large insurance companies, they understand that credit is delivering really good returns in comparison to, let's say, 5 years ago. And that's why they want to lock in their capital as well. And they're slow to react. So it's completely correct what Don said. There's no slowdown, but that comes with the slow adaptation to the new trends. But I would say next year, when interest rates are going down further, less and less family offices are going to invest into private credit. So people have to really fast in order to lock up the high interest rates we have at the moment.
Okay. Debbie, again, before we go into other areas, and we haven't got a huge amount of time, I wanted to see whether you see any particular trend in terms of your clients, in terms of what they do in Europe in private credit. Are they mainly going to Luxembourg to set up there? Or do you any structuring thoughts you have and/or domiciliation thoughts you have on what US managers are doing?
Yeah, I mean, I think Luxembourg of the jurisdictions compared to Ireland is still probably the kind of preferred jurisdiction there. I mean, we do see a number kind of go with the kind of traditional Delaware, Cayman structure as well, for a number of managers, depending upon, who they're targeting. Some European investors are okay with that. Others, as I had mentioned earlier, are looking for more of a European structure. And I think typically they're going to Luxembourg. I think one thing just kind of think about also in relation to, private credit, particularly in relation to the, kind of default topic, is that, their tip structures, including sometimes in relation to, kind of asset-backed leverage in connection with particular investments, which obviously you do need to be, careful about from a disclosure perspective to make sure that, the investors understand exactly how you're using leverage. It's definitely something that we've seen, come up also in regulatory exams, and a focus area from the SEC, and making sure that the investors really, understand both how you're using leverage, making sure that you have the appropriate disclosures and authorizations, and then also making sure that you're clear about how your fees are being calculated in connection with the use of that leverage, and whether that's using, kind of NAV loans, which have become, more popular just general in, kind of the private equity space, or if you're talking more about this asset-backed leverage. I think that's something that, managers need to think about. And I think it's, particularly savvy investor, just a kind of general section that we may borrow, or we may use leverage, I think is not really what I'm kind of suggesting to clients. It is better to be more clear on those points.
Okay, right, before we get into questions, let's go and perhaps quickly have a more general look at the market, in terms of maybe I'll come back to you, Lars, and say, outside the whole private credit area, what's happening that you see in other strategies, that particularly in terms of US GPs coming to Europe?
US GPs coming into Europe, they have to up their marketing budget. They have amazing products, and the returns are still very, very good, no matter what they're doing, whether they're going to credit or whether they're going to equity. But due to the policies, the government policies in the States, some of the LPs are very cautious where to deploy their capital. Traditionally, a lot of the LPs have always allocated around 47% of their dry powder for international investments. And international investments meant simply US straight away. Now, a lot of the LPs are looking also into Asia, Australia, and try to find alternatives until they know what's going on with the US policy. So equity, in my opinion, is another topic for next year. When interest rates are dropping, equity investment opportunities will increase, especially when you're thinking about asset-backed securities.
Okay, thanks. Now, I see questions are coming in. Don, I'm going to come to one of those questions, ask it to you to answer, because you mentioned earlier that you have a big office in Dublin. And I don't know whether you service private credit in Luxembourg as well as Dublin, but there's a question here: are there any real differences between Ireland and Luxembourg in terms of their regulations, costs, service levels, etc.? I mean, you can answer both for private credit if you want to go outside that. Debbie, maybe you can go outside, and then, because you probably look at those markets all the time for lots of different clients of yours. But Don, you first. How do you see? How would you answer that question from somebody?
That's a great question. To your point earlier, right, the illiquid funds are predominantly what we're seeing and getting the request for the Luxembourg entities. Most of the liquidity funds are coming through Ireland, and the servicing through there. I'm not sure how to position that the correct way in regards to the regulatory requirements in each jurisdiction. To the best of my knowledge, Luxembourg is much more stringent in the requirements that they put on these funds. Hence the reason why we have a significant presence in Luxembourg and servicing those funds out of there, as opposed to Ireland. But I would defer to Debbie from a legal standpoint in regards to that caveat.
Yeah, I mean, I think that, I guess the first thing is I would say they're both significantly more expensive to run compared to, kind of US and Cayman vehicles. And I think part of that is just kind of infrastructure service providers. I mean, often you're going to need to have, kind of different service providers. I think the one other thing that, tends to be a little bit more difficult with both of those structures from just a process perspective is, having a board of directors and some level of, kind of oversight, that is different than what you would typically see in, kind of the involvement of the Cayman directors. There is just a lot more, kind of process and procedure, whether that's having to get, kind of notarized subscription agreements in some instances, from the investors, which you're not used to having to do in the US. I mean, I think depending upon the type of structure that you have, there are some that are very, close legally, partnerships that are based primarily on, US, Delaware law. So Ireland and Luxembourg both have, products depending upon what you're using, the vehicle for that are going to be very similar. And so often the documentation for your partnership agreement doesn't have to look that different. I think where it really comes down to is, kind of the structure, the service providers, things that you might need to do regarding valuation, just the process of interacting with the regulators as far as getting certain approvals, then, kind of updating them before you're going to make changes to your structure or your documents. Those are just things that you don't have to do in the US and the Caymans. You might have to make some filings after the fact, but you're not going through this kind of back and forth that you would see really just only in, kind of the registered 40 Act space in the US. And so I think that's where there tends to be, kind of the biggest difference for managers.
Right.
And to follow up on that, I would say that, to dovetail off of what Deborah said, it depends on the regulatory framework that client is trying to satisfy, right? It depends on which jurisdiction they want, do they want to be in Luxembourg? Do they want to be in Ireland? Depending on what strategy they're trying to, get the favorable regulatory workings of their fund.
Okay.
Yeah, I think you also have to well, the devil is in detail, right? You have to look into the particular LP. If it is a large pension fund from Nordic country, they might require Luxembourg because they have invested in Luxembourg through Luxembourg feeder funds going to the States. So they are very familiar with that one. I would say Ireland has done a brilliant job over the last years to create a framework and a structure where LPs feel very, very comfortable leaving their money over there. And if you think about smaller investors, such as, let's say, family offices, single or multi, or smaller wealth managers, they can be very often very flexible because their focus is more on the return side. Then obviously security has to be there, but return is also a huge topic for them. So they want to help those GPs to keep the costs very low. And if the GP then says, I don't want to go to Luxembourg because the costs are extremely high, because everybody goes to Luxembourg, I'm happy to go to Jersey or Guernsey or even Ireland, then the smaller LP might follow.
Yeah. It depends, as you say, on who the LP is and whether they have a regulatory requirement to be in the EU. If they don't, then obviously they're not going to necessarily go down the route of paying all that money to be in the EU. And that's, as I said in my presentation, is probably the key determinant. It gets more difficult when they have some investors who are in that category and some who aren't, and so on and so forth. But increasingly, we find that it's targeted to so specific a group, and maybe they'll have a feeder in one jurisdiction and another feeder in another and stuff like that. Before we may come back to private credit, but I see there is a specific question. Presumably, there's a real estate manager on this call, and he or she asked the question. I don't know whether there's anyone here who can answer it. Debbie, you may be, although you're sitting in New York rather than Dublin or Luxembourg, but you may be looking at this for your clients. What are the typical annual costs of hosting a mid-sized real estate fund in Luxembourg? Do you have mid-sized real estate managers in your client base? That's a really difficult one to throw at you out of the blue like
I
that.
don't know that I know, exactly what the costs are for that. But I think everyone has kind of said this, I think it is going to be, if you're comparing it to kind of the US costs, I think it's going to be, significantly, higher even just to get the service providers and all of that. But I don't actually know exactly what the annual costs are for that one.
Why are the costs? You said that before. Why are the costs so much higher in Dublin and Luxembourg than they are in the US, do you think?
Well, I think part of it is just, in the US to form an entity in Delaware, right? It's, you're talking about really, a few $100s, and, you don't need to have an independent, board. You can have the GP control it. You can do things pretty cost effectively. Obviously that's not going to be, a structure that works for everyone. But if you're just talking about US investors, you could do that, fairly inexpensively. I think with Luxembourg, I think in general, kind of you're dealing with having to have a number of different service providers that you just don't have to have in the US. So whether it's things in relation to, kind of valuation and admin that's doing those things, there's just a number of kind of extra costs. And then I think just the entity, formation, notaries, like all of that, just kind of adds up, which are all things that you don't have to have when you're setting up US entities.
All right. Fair enough. That's a very good point. And it does remind everyone, and it is the case. I didn't mention it today, but perhaps I will do so now. There's a lot of effort by the EU, and it's been since they brought the original AIFM directive in, which is now a long time ago, to try and gain some control over what all these dodgy, well, from their point of view, I'm being a bit naughty, they see these Anglo-Saxon managers in the US or even the UK when we were in the EU, or Australia or wherever, generally a fund management in whichever area, there's been an Anglo-Saxon activity, and the EU's trying to get their hands on it and get some control over it, which is why they've laid cost on cost and regulation on regulation. I don't know whether anyone would want to dispute that, but I think it's the case. If they're not going to dispute it, I want to go to a question where somebody so this is a very technical question. Someone's actually given their name to this one. So if you give your name, we'll certainly read it out if I can pronounce it. That is Maurice Pierre Salguero. Has Debbie explored the Luxembourg SCSP brackets Luxembourg LP? I probably really butcher that question. Do you know what Luxembourg SCS lowercase p is, Debbie?
I have, yeah, I have. I've had a few clients use that in particular for some co-invest vehicles. So where they were doing, a private investment in a European private company. There have been, from kind of the deal and transaction perspectives, some instances where that's been, kind of preferred from a tax and from a regulatory perspective, particularly when people are thinking maybe about, take private transactions or other things in Europe. And so I have had, people use that structure. I would say that one can generally be a little bit of a lighter, lift. You still have to have some additional service providers. There, I would say the LPA is very similar to what you would have in Delaware. I think similar to what Ireland did, for their LP. It's a pretty similar LP PA. So there were, really kind of only a few different types of changes that needed to be made. I think one of the things that does come up there is that I believe that all the subscription agreements do need to be notarized, which some investors do find to be difficulty and something they're not really used to, especially in the age of kind of electronic signatures being used here in the US, and DocuSign, which is generally the preferred method here. But I think generally people have found that to be a pretty quick setup. I mean, generally in the kind of co-investment space, you're moving at a quicker pace than you are in connection with a commingled fund, and people have found that generally has worked pretty well there. I think some people have still felt that sometimes the service providers there are a little bit, more difficult. I think there does tend to be a little bit of a, kind of accommodation factor that you have for some service providers in the US when you're dealing with certain things, that just in your in relation largely in part to I think the regulation that those service providers themselves are subject to. They're just not always as able to be as accommodating on certain aspects, and there does tend to be I think from US managers perspective, I think there's a view that there is kind of less flexibility when dealing with some of those matters as compared to when they're dealing with their US service providers. But I think again that generally is typically coming down to the regulation that the different bodies have.
Okay. I'm going to deal with one question I think probably is aimed at me, and then we'll probably get into the last question for you all to wrap this up, which is, can you define what you, sorry, I'm going to do the other one. Do you provide information on fund directors, since that subject's come up a couple of times briefly today in Cayman as well as Europe with our Atlantic Fund Intelligence thing? Absolutely, yes. We actually started helping GPs or managers of different shapes and sizes with Cayman selection before anything else. But I've mentioned more about what we're doing with US managers coming to Europe. And if they're looking for people in Dublin or Luxembourg, we do help with that. But yes, we do still get lots of questions, or quite a lot of questions, not as many as we used to, but still some on what's going on with the Cayman director community as well. So, okay, that's probably done the questions. We got maybe, well, if there are any more questions, I'll see whether we can answer them afterwards. Sorry if we didn't get to your question. I see there may be one or two other ones we haven't answered. So just to wrap this up, can I come to you, Don, first, looking into next year specifically? I know you're obviously a specialist in private credit, but overall, can you give some forecasts about where you think the whole industry that you're in is going? And I'm going to ask Debbie and Lavin for forecasts for 2026 take it any way you want. But let's start with you, Don.
Are you talking about from the US market perspective or the
well, the US market and coming to Europe, which is obviously in terms of where, but also overall, what do you think is going to happen in private credit, but what's going to happen in terms of US managers coming to Europe in this strategy?
Yeah, so I think from the U.S. market perspective, right? I mean, the market now we're exceeding $1.5 trillion, and roughly more than 500 new managers have come into the space on the U.S. side.
Wow!
So I think you'll see, there's a lot of competition to kind of get deals to allocate capital, and I think you're seeing that. Excuse me, you're seeing the Tory uncertainty here in the U.S. and just everything with the current administration that's causing some angst with the U.S. markets. I think you're going to see some of that movement more and more of that focus towards the European markets, right? I think you're seeing the deals on the European side are somewhere 25 to 50 basis points higher than they are in the U.S. equivalents. But there are some challenges that they have to go through, like Deborah was saying, around the licensing and the domiciliation of where these funds are and what they have to go through with the regulatory requirements, and just the operational complexities, right? Managing those subscriptions and reporting across the multiple jurisdictions that are going to require systems like we put in front of our clients to kind of really get that information across to their LPs and making sure it's it's accurate as possible, given the multiple jurisdictions that these GPs have to now operate in.
Thank you. And Debbie, if you can do a short, specific answer, any quick bullet points as we're on the top of the hour, we should be closing up shortly. Have you got any particular final thoughts you want to say about next year?
Yeah, no, I mean, I think again, we're going to continue to see a lot of this being driven by, investors and where they're looking for, the domicile to be. But I do think that people are, managers are finding that there is more interest, in Europe enough to kind of, dedicate the resources, whether that's thinking about, switching from reverse solicitation to the private placement regime and AFMD reporting and kind of going down that road. I think we're going to continue to see the trend with, kind of a focus on private wealth, distributors and kind of that, kind of quasi retail market, which I think, is going to continue to, kind of expand some people's access, kind of across beyond what, what they may have originally done. I mean, I can just say anecdotally, I mean, for a number of years, people would push back and say, hey, I'm not going to, let you market my, my fund in Europe because of AFMD and other things that I'm going to have to do. And now I think they're, and for a while, the, kind of distributors were saying, okay, that's fine. I think now there's been a little bit more pushback because I think they do have, kind of more interest, particularly some, of those platforms, their base is not necessarily US investors, and then I think just generally in the industry, I think we are seeing more of a trend towards SMAs, kind of funds of one and kind of, bespoke strategies that are combining a number of different things, whether that's kind of a more liquid sleeve, and then, whether it's through co-investments or through investments in other funds, credit or, kind of growth equity. I think that's something that, a number of larger institutions are looking at to kind of have these, kind of combination products.
Thank you. And Lavin, can you do this in seconds? Can you give your prediction for next year?
Sure. So let's think about LPs. The family offices in particular, they're going to look more and more towards equity investment opportunities because there will be some smart, operationally strong GPs out of the States and Europe who are going to capitalize on the current market situation. The institutional LPs, such as pension funds and insurance companies and sovereign wealth funds, are going to continue on the credit investment opportunity angle, but the interest rates might go down, and that will be the situation where the institutional investors are going to wake up and start to reconsider equity again.
Thank you all very much. For the relatively few you are still with us past the end of the hour, thank you for sticking with us for the full hour and more. For those of you out there around the world, we are going to be doing a special report and a webcast like this, probably specifically on private credit before long, and we have a whole host of other things coming up. Thank you very much for following us. Have a good morning, afternoon, or evening where you are in the world, and hopefully see you all the next time. Bye bye, everybody. Hope see you soon. Bye bye.
Cheers.
Bye.
Bye bye.